Thank you guys all for joining us. This is today's Tax Talk Live on Trust and Estates. And as well, obviously, thank you for sticking with the technical difficulties. We have Mr. Jim Holmes with us, who's an enrolled agent. He's been doing trust and estates for quite a while, at least over 30 years, and we really appreciate him sharing our expertise and his expertise in serving as a group expert. Um, so just to kind of get this started, first question, Jim, would you be able to give us a basic rundown of trust and estates as well as, what there's to look out for when doing them?
Well, trust and estates are actually two different things. A trust is created by a living person generally, and an estate is created after that person dies. They have a lot of the same traits, but then not all. They both file a 1041. The estate can use all the income and expenses, where a trust is, depending on what type trust it is, it's limited on whether it distributes capital gains and things of that nature. Trusts are generally set up. Well, there's a couple of reasons. The attorneys are pushing the fact that if you set up a trust and you have all your assets in it for 5 years, then Social Security can't go after it after you've been in a nursing home. You have to have the trust for at least 5 years for that to qualify. Now they've come out with another thing, which I'm not going to go into, but it's just transferring property and keeping part of the ownership opposed to trusts. Trusts are a good thing. Trust means people can reach out and dictate or tell people what they want to have done with their assets for many years down the road. In fact, you can have a trust that lasts forever until everything runs out. Most trusts have a period of time, but they don't all have a period of time. Generally, they run out when the last assets are distributed. So, and again, estates are set up after a person dies, and they handle their assets according to what the will says if they did one, or according to what the state says if they had one. Is that all right?
Yeah, that's perfect. Yeah, thank you for explaining that. It also answers the next question of what is the difference between a trust and an estate. So would you be able to kind of give us like a general timeline of what it looks like from beginning to end in terms of setting up a trust and, the processes that follow after that with following through?
A trust can last 30 or 40 years, or it can last 2 years or 1 year. You can file the beginning and ending trust document 1041 for the same year. It just depends. It depends on what is set up in the trust to begin with. Generally, and I get this question a lot from people, that generally they say, I've got this trust, but I don't know what it is. Well, generally, if you look at the first paragraph, it's going to tell you what it is. It'll tell you what kind of trust it is. It'll tell you whether it's a grantor trust or a irrevocable trust, and you can have a grantor trust that is revocable, or a living trust, and you can have an irrevocable grantor trust. What makes it a grantor trust is that the individual setting it up has retained rights to all the income. As long as they have all the income rights, then they're the grantor. It doesn't matter. And they will continue to report all the income on their tax return just like it was before. But that the assets creating the income are sheltered. If you have a revocable trust, that means when they say revocable or a living trust, that means that they can change it anytime they want to. They can pull assets in, put it out, change it, change beneficiaries, change everything. If you have a irrevocable trust, you're not supposed to change it. Once you set it up, sign all the documents, that's it. You can still add capital and funds to the trust, but you cannot change distributors or whatever. I know some attorneys try to put a thing in there where they can change a little bit, but have trouble with that. But there are reasons for having a revocable trust, and there's reasons for having an irrevocable trust. The main thing is if you have a revocable trust, that means you can change it anything you want all the way up till the day you die. The day the person dies, it becomes irrevocable at that time, and then it cannot be changed other than for the trustees and things of that nature. It's a good thing where they want to set out where they want the daughter or the grandchild not to have any income until they're 20, and then a little more when they're 30, and then when they're 50, they can get all that's left. I mean, they're reaching out and controlling the funds and what people can get and who gets it, when they get, and what they get. That is not necessarily the case with a revocable trust, although if those stipulations are put in there, then it is the case. But it can be changed at any time.
So thank you so much. And does anyone have any questions and want to jump in and ask them?
Tim, this is the real Joshua Caulfield. In your experience, as you've been engaging with people, what do you use as factors to encourage people to choose a revocable versus irrevocable trust?
Well, the main thing is you ask them what they want. It's not what I want. It's not what the attorney wants. And you explain to them that if you want to keep it open and then just be shut off and sealed date of death, then they can have a revocable trust, excuse me. A revocable trust does not give you protection from creditors, which is another. I talked about Social Security not being able to get to it. Well, if you have an irrevocable trust, they're protected. That's protected from creditors, where a revocable trust is not protected from creditors. So, I mean, those are the big things. One is creditor. I have a client that's, we just live in a little town in North Carolina, and I'll just make it a fairly straight thing. He married a lady that already had a daughter. She was just a baby at the time, but he adopted the daughter and brought her along, and then they had a daughter. So he has a stepdaughter and a real daughter, or adopted daughter and real daughter. Well, the adopted daughter, he put her through college, got her degrees, set her up in a business. She had the business up for a year or two and just let it run in the ground, took all the money out and everything else. The other daughter's gone, got a master's in accounting, does all kind of stuff, works every day with her father. And we set up a trust because it started out, he didn't want to leave the one daughter anything. I said, well, you got to leave her something or everybody will be in court. So now it's up to $100,000. The estate's going to be in excess of $25 million. A good part of that has already been put in a trust. All of it cannot be put in a trust. And it was a lot of work, and you had to go through it because the individual liked to have his hands on everything. And when I told him if he did it, he couldn't change it, he was not too happy. But now he's tickled to death to have a trust. But that works for him. Same individual, his daughter has a child that has handicap tendency. She's 24, I think now, with the mind of probably a 11 or 12-year-old. She has graduated from a community college and all that, but she's got issues. And we set up a trust for her, and that trust is a specific needs trust to where she can still draw Social Security and all that, but it can have $1 million, $2 million in it, which it does. Kelly, you have your hand is up. Did you mean it to be up?
It did. I just couldn't find my mute button, which is anyway.
I must find mine.
Yeah, people are looking for mine for a long time. Can you speak to the effect of basis, any difference in step up in basis between the revocable and irrevocable character?
Great question. If you have A revocable trust, date of death, everything gets a stepped up basis. If you have an irrevocable trust, in most cases, nothing gets a stepped up basis. It's whatever it went in there. There are exceptions. The primary exception that I'm aware of, and the only one I'm really aware of, is if you put a personal residence in a trust. That sounds simple, doesn't it? If you put a personal residence in a trust, it has to be a grantor trust. Remember, I said if it's a grantor trust, all the income and everything, expenses go to the individual that set it up. Well, if there are cases where if the residence is in a irrevocable grantor trust, it can still get a step up in basis. Now, and I've got the thing somewhere. I see your eyes rolling, and I've got the site somewhere. I can find it if you want it at some point. But that can be done. But the biggest thing is everything gets a stepped up in basis date of death on a revocable trust. You still have a lot of control on a revocable trust, but you can set up things in a revocable trust that are hard to set up in an estate. People want to get their estates closed within a year or two. I had an estate that was open 11 years. The county clerks called it the estate from hell, and I'm not going to tell you what I called it. But anyway, I did learn that you don't get involved with somebody that they haven't settled with their first wife when the second wife's still coming around wanting everything. So, I mean, it was a lot of fun. But I'm not answering your questions. I'm just telling you things. But I really think after several years that trusts are a good thing to have for a lot of people. But if you don't have a lot of investments, you primarily just have real estate and your house and a few dollars in the bank, but there's a lot of other ways you can go without putting it into a trust. Now, if you're concerned about somebody knowing what you have or you want protection, then you might want to put it in a trust. But you don't. I recommended some people, I just said you don't need a trust, and they didn't have that much. They're still a young couple, and 20 years from now, they may need a trust. They don't need it now. So I'm going to quit talking in a minute.
Well, that's what we're here for.
So,
Jim, did you tell everybody what you tell me the first thing? Have you read the trust?
yeah, that's in my paperwork. Anytime
I think he told me that yesterday. Have you read the trust?
Anytime somebody calls me, the first thing I ask them is if you have read the trust. The handouts that I sent to them, the last page of the handouts, it's got the basic 3 things you need to know when you're dealing with a trust. And it's on page 3, and it's read the trust, and read the trust. And if you haven't read the trust, you shouldn't call anybody to ask them because they're going to ask you to begin with. Have you read the trust? Now, somebody called me and I said, I don't know what kind of trust it is. I said, have you read the trust? Well, a little bit. Apparently, you didn't read the first paragraph or 2 because that always tells you what type trust it is. Bill?
You made the comments about the step up in basis. Is the reason why that you get the step up in basis because, as you said, it's a grantor trust? So anything in there that you'd be a grantor irrevocable trust, because what then happens is creditors can get into that. The fact that it's not fully separated, basically, as far as assets compared to an irrevocable.
Right. But it's harder for the creditors to get into it if it's a irrevocable grantor trust.
Right.
The other is statute. You're getting a step up in basis on real estate, and it's very limited. You got to meet certain conditions, but that's it.
Okay, so it's a statute that actually allows for the primary residence. Okay.
And I got it. If you want to later on, I can tell you where to look. But Miriam?
Yes, hi. So going back to the step up in basis, how would it apply to a personal residence once the person passes away and the trust becomes irrevocable? And the second part of that question is, does a residence in a trust that now is irrevocable, what about the section 121 exclusion?
Okay. The first question is date of death. You should get an appraisal of the real estate, and that's what tells you what the fair market value is. People don't want to spend the $500 to get it. They'd rather lose $2,000 or $3,000, $4,000 in taxes down the road. But you need to get an appraisal very close to the date of death. You talk to an appraiser, I've talked to an appraiser, and they appraised it 2 years prior what they thought it might have been based on everything surrounding and whatever. But it's best to have an appraisal, and that is what your step up in basis is for the real estate.
So once the person passes away and the trust is now irrevocable, they do an appraisal on the personal residence and they receive a step up in basis.
That's right.
And you have somewhere where we can refer to that? We can cite something?
Yes, you got to meet certain conditions to do it. I don't recommend it.
Why?
That's something that you got to. There is also a personal residence trust, which that's specifically set up for that.
Like a Ladybird trust.
Mm-hmm.
Is that called a Ladybird trust? Is that what you're talking about?
I just know it as a specific residence trust.
I think the Ladybird, I think you're referring to, Marion, is a way of holding title.
Yeah.
So it's like joint tenancy with right of survivorship as a way to hold title. The Ladybird, I'm not a lawyer, right?
No, I spoke to an attorney and she was telling me about a Ladybird
Right.
trust is where they put the personal residence in that trust. So
Yeah.
once you do something like that, she said, then, you can get a step up in basis. And I'm
Right.
so confused about the
You
step
still-
up in basis.
Yeah, the Ladybird, you still retain your step up and you still retain the ability to sell it while mom's still alive and keep the
Right.
121. But keep in mind, the
Right.
121 issue goes away once they pass. You get a
You
step
can't
up in basis. You
You don't
do a
need
hallelujah
121.
dance and pardon?
Yeah, you don't need 121 anymore.
Exactly.
If you get the step up in basis, you're good to go.
Right.
That's
Right.
gold.
The main
right
thing
there.
is getting a step up in basis, and the 121 goes away after 2 years, as long as the person was living in the house. Now, the one that I'm aware of, the individuals wound up, the people that inherited the house wound up living there, but that's another story altogether. You can go through and have all kinds of things. The best thing to do is you're dealing with the trust is to read the trust, understand the trust. And if you don't understand the trust, then call the attorney. Actually, if you want to call the attorney, you can tell him hello and then talk to the paralegal so you can find out what the trust meant. But and I'm not down on attorneys, but it is a big thing. Trusts are a big thing. Most trusts are really done for your protection or for the individual to reach out and distribute assets after they pass, or to shield everything from creditors. I mean, they're for your protection. That's shielding from the creditors. But you can do all kinds of things with the trust. And I don't even want to go into all the trusts there is. I got a thing here. It's got about 30 different kinds. Most of them are basic trusts. But the thing about a trust is that if you read it and you read the first couple paragraphs, going to tell you what to do and what type of trust it is. As you go into it, it's going to tell you how they want things distributed, who can do what. They spend 2 or 3 pages on how to replace the trustees and whatever, if you don't want to be the trustee or if you are the trustee. But they're spelled out exactly. Now, I know that all attorneys and people writing trusts read them very carefully, because a few years ago I had a trust and I was reading through it, and halfway through the trust, the whole name of the people and everybody involved changed to a prior trust. And if she forgot to change the wording when they were typing it up on there, and it was right funny. the young lady was embarrassed, but we got it worked out. But that, I have seen it where they just, they just have a plate, they just go do it and that's it. There's more to it than that, but anyway. Anybody have a question?
Yeah. Ellen, did you want to go ahead?
Do what?
Oh,
I
Ellen?
actually didn't have a question. I had, I wanted to add some additional information. The key to the stepped up basis is whether the asset is in the person's estate or not. If the trust is a revocable trust, everything is in their estate for estate tax purposes and therefore gets stepped up. The other grantor trusts, with almost all grantor trusts, the IRS says that the owner still owns those assets, that it isn't the trust that owns it, and that's why they get a stepped up basis. Some irrevocable grantor trusts will get a stepped up basis because they end up on the 706 in the person's estate for estate tax under section 2037, 2030, or 2036. But some irrevocable trusts that are not grantor trusts, because the person does not own that asset, they don't get a stepped up basis. There's one exception. There is an intentionally defective grantor trust that is an irrevocable grantor trust that does not end up in the person's estate. And that's the one irrevocable grantor trust where there is no stepped up basis at death.
Very good. Thank you.
You're welcome.
She's absolutely right.
I have a question. This is Latrice. So how do we handle our clients where they're always on social media and it's oh, you need to get a trust, and it is saying own nothing, control everything. So they want to put everything, including their moms, in the trust. I mean, it's like they got 5 LLCs, then they got another business, like everything they want to move in a trust. What is your guidance on these people that just listen to too many things that are on social media? And I know it depends upon, and it's a lot in my generation. They want to put everything in a trust because they feel that they can still own it. Well, they don't own it, but they control it. And I really don't understand the purpose, because from what my research is, it's a revocable trust anyway. So creditors can come after the trust.
Revocable trust, that is true. The creditors can come after a revocable trust. It is not, everything is not protected in a revocable trust. An irrevocable trust is another story. And the first thing I do is ask people what they really want, what they want to protect, what they feel like they need to protect, if they have anything to be protected, and then we go from there. And then I send them to an attorney.
Okay. But for tax purposes, as long as it's in a revocable trust, we file the taxes the same. Nothing changes.
If it's in a revocable trust, yes, it'll go through. And even if you have a revocable trust and they have a 1099-B, it's going to come out. If they have a capital account somewhere, that's going to come out, an investment account, somewhere, it's going to come out as the revocable trust with their names on it. So it's going to be reported on their tax returns.
Perfect.
And that's what it is.
Okay, thanks.
I had a client a few years ago where they had, I think it was a total of 15 different irrevocable trusts, and they had several LLCs. And the entire estate was probably worth about $2 million. And it was, if I was an accountant at the time, I would have absolutely loved it, because the fees for every one of those filings would have been just wonderful. But the point of it was, like, then they wanted to break it all up, because it was like what they had discovered, because they listened to social media that said you need to do irrevocable trust. The assets you have someday could be worth a fortune. You have ownership. You have control, but you don't now have ownership. they fell for all that. The problem is you add complexity, and all of a sudden it takes paperwork to get anything done, and usually an attorney to get anything done. And so I always tell people, going along with everything else that you said, Jim, as far as what exactly are you trying to do with this, and does it really achieve the goals? And then the end is like, do you want to add complexity to your life? Is it really worthwhile? There are assets to protect from creditors. However, and I've working with attorneys, I've seen this. The veil can be easily pierced. If you're involved in a car accident that basically causes the death of other people as well as your own, if you think your irrevocable trust of death is going to protect your assets, you're incorrect. Because what will happen is it became irrevocable at your death, which meant the liability for all the trusts existed at the time of your death, and that's what they'll argue to get the millions. So the veil can be easily pierced. If you own an apartment building and you're not maintaining it, don't think that the LLC is going to protect you, because your failure to manage the property correctly is what is causing the injury. That's what they'll argue. So there's things like that you have to really look at and be like, exactly what are you trying to do? Because a lot of the protections that people will talk about in the media, no, a good attorney will get right through that. No judge can look at a injured party and say, I'm sorry, you can't get any money because it's all now in an irrevocable trust, and it's been there now for 3 days. It doesn't happen. So, and they become wards of the state. Not going to happen.
Thanks.
Can an
Jensen?
LLC have a trust as a partner,
Yes.
but a S corporation could not? Am I thinking
Well,
that right?
No, the S corporation they have a special trust
That
for
page 2 form you have to fill out.
Well, yeah, and this S corps in a trust wind up being taxed at the highest tax rate, and they're taxed separately from everything else in the trust. So you can have it, and they also have a I forget what to call it exactly. Ellen probably knows, but it's there, but it's a SSB trust or whatever. I got it.
QSST.
ES, yeah, that's what it is.
Qualified Subchapter S Trust or something.
Yeah, it's EST trust. But anyway, you can have it, but they're taxed at a higher rate, and it's not always good, but that's the way it is.
But Ellen's probably, she's got her hand up. Go ahead, Ellen. Sorry.
Actually, I was going to address another question that was asked before. So if you want to continue with this topic, you can.
Oh, go ahead.
Well, let me one question, if it's a grantor trust, it's a disregarded entity, so it can be, and this is a question for clarity, yes. If I'm an S corporation with an LLC formed as an LLC, I can move my LLC into the grantor trust, my LLC membership, right? Into the grantor trust. It's still a disregarded entity. I don't have a QSST issue, right?
That is correct, until the person dies.
Right, and that's when you get the Q.
Right.
Okay,
Yeah.
perfect.
Yeah. Latrice had asked why people are putting things in the trust, and there's 2 major reasons for a revocable trust. The most common reason is people do not want to go through probate. With a trust, you avoid court, the probate court. The other reason that people will do a revocable trust is if you have property in more than one state. For instance, if you live, I have a client, she died, she lived in Texas, but she had property in New Mexico. If you use a will, you have to open probate in every state that you have real estate. So if you have, we had to do probate in Texas where she died, and we had to do probate in New Mexico because she had a house in New Mexico. Or if you have a revocable trust, you don't go through probate anywhere, so you don't have to be involved in courts in multiple states. Now, I recently had an estate and he owned property on an island, and we had to do probate in the United Kingdom because they owned that island. You can avoid probate in multiple places by using a revocable trust.
Thank you very much, Ellen.
Thank you.
Oh, Maria, you have a question?
Thank you, Ellen.
And to find my unmute button. I
Yeah,
have a
there you go.
question on the grantor trust, how they're supposed to be reported on the K1. So I have people that like to do all kinds of fancy titling of their 2% interest in a partnership, which then potentially risks them whether the partnership can make the BBA opt-out election. But my understanding is that if a grantor trust is a disregarded entity, then the K1 should be issued in the John Doe name with their social security number. Is that accurate? Are you able to comment on that?
No. If it's in the trust, the assets will still be using the name of the trust, but they can use a social security number. So the K1 of the partnership should be in the name of the trust with the social security number of the grantor of the trust, unless the trust has obtained an EIN. Then you do need to put it in the name of the trust and the EIN of the trust, and then they will actually do a grantor 1041 and pass it through to the grantor.
Well, thank you again, Ellen.
Thank you,
All right.
Ellen.
Yeah. Someone asked in the comments, can you expand on the benefits of having a principal residence in a trust?
Go ahead, Ellen. You do it better than I do.
Well, it depends. If you just are going to have a revocable trust because you don't want to go through probate or because you have property everywhere, having your personal residence in a revocable trust is treated as if it is not in a trust. You can put it in an irrevocable type grantor trust. And that actually, I think you know more about, Jim, than I do, so you can talk about that one.
Well, you can put it in a grantor trust, but unless you have a really good reason for putting a personal residence in a trust, I just wouldn't want to do it. Although you can, and if it's in a grantor trust, it doesn't become an irrevocable trust till date of death. So as long as it's in a revocable trust, you don't have near the problem when it goes into a irrevocable trust, then you can have a problem. But as long as they're in a grantor trust, they're going to get the stepped up basis in most cases.
Thank you, Jim. Kelly, you had a question? Oh, and then Jency?
Yeah, I was going to make more of a kind of in the flavor, and others may want to comment on this, kind of the flavor of the planning component, and recognizing, number one, if the client sets up a trust, the trust needs to be in sync with the will and in sync with the title of all the assets, right? So you may have a trust and you want the trust to you want funds from your IRA to go into a trust for the grandchildren, right? Well, the beneficiary of the IRA needs to be the Kelly Myers grandchild trust, right? So it all lines up. And a lot of people don't do that, right? They'll have bank accounts and real estate and all these things titled one way, and they go, oh, I think it's in a trust. Well, it's not in a trust either until you move it into the trust, or you structure the titles. I mean, one thing I am shocked by people all the time is, I said, have you reviewed your beneficiaries, right? So in all this kind of holistic discussion of, they're like, well, everything's going into the trust. Well, it's in a trust or it's not, but if it's not in a trust, then how do you have it? Because, for example, if you have your investment account and you have a designated beneficiary of your wife, who's now an ex-wife, and you never update that, the ex-wife's going to get the portfolio, right? Because that that TOD, that transfer on death and payable on death designations trump the will. So I guess what I like to say is, we're discussing kind of one slice of the pie or the crust of the pie or something, one part of the whole equation. So just don't. And again, I think I see the attorneys, and I think that's what I was hearing too, is you see the attorneys, like Jim saying, kind of jump and they just one size fits all and they throw it out there. I have somebody recently I talked to, the taxpayer had identity theft, and the answer from counsel was put everything in a trust. And I'm like, what's that going to, if that accomplishes something magically, let me know. But I'm like, I don't know, that's not going to solve the concern you have. But anyway, holistic approach.
Thank you,
Yes.
Kelly.
Jim and I may have discussed with you, we have our home, Ben's home, it's in a trust, and it is in the name of the trust. Then we have other assets that are not, but the trust actually says in the trust agreement, whether they are titled in the name of the trust, it still goes to the trust. Is that legit?
No.
Because the only thing we really changed was the title of the house.
No.
Jimmy
Yeah,
Haynes
they-
Accounting is still, or Haynes McCray Accounting still over here, Haynes McCray Accounting. But my trust says that Haynes McCray Accounting goes into the trust
No, that does not. You have to change title.
for
Yeah.
everything.
Yes.
And for years, I've had people bring trusts in, and we'll go back. I've been doing this for 2 or 3 years now, but back before I retired the second time, I had people bring in trusts, and all of a sudden there was nothing in the trust. And you look at the trust, you read the trust, there was $5 and whatever else, and you say, "What else have you put in the trust?" "What do you mean?" I said, "Well, have you titled your home? You titled the farm? What have you titled in the trust?" And they don't do it. Now, a lot of attorneys are doing that now, but for years they didn't. And there's a lot of those trusts out there that people just don't know.
Now, Jim, and Ellen said it too, I think, was titled in the trust. Either would it be cleared for clarification to be titled in the trust, or the trust is the beneficiary of that account? So it lands in the trust. Is that
That'll work.
okay?
It can be TOD to a trust. Though I will tell you right now, I don't recommend that you put the trust as a beneficiary of IRA. It has become very complex now. Unless you want the money to remain in the trust and to go to the trust and not go to the beneficiaries. So if the money needs to be managed and not go directly to your children, for example, then the only reason to leave it in a trust is if you need to manage the money for the person. Otherwise, it's a mess.
Big mess.
Wouldn't the trust have to pay the taxes on the IRA when it went into the trust?
No, well, if it is distributed to the beneficiaries, if the trust says that it is to be distributed to the beneficiaries, then it'll be taxed to the beneficiaries. The problem is that if the trust says all income is to be distributed, that is fiduciary accounting income, and the IRA income is not 100% income. It depends on which state you're in, but most states, only 10% of an RMD is in income. The rest is principal. And if the trust is not allowed to distribute principal, then the trust will pay tax on it. So if you want the beneficiaries to pay tax on it, the trust has to classify the proceeds of an IRA as income.
Out of curiosity, in a lot of trust documents, there's always a property property assignment addendum where it says all the stuff that's in your personal home is automatically part of the trust. Can you do that with a residence or and cars and all that? So that's where, again, if it's if something has a deed, then the deed has to you have to change that to the name of the trust, or you have to put in that deed that it's a transfer on death to the trust.
Yeah.
Those be the solutions. Okay.
With one exception, and that is the vehicles. A lot of insurance companies don't like to insure vehicles that are titled to a trust. And my state, it's easy to transfer title from one person to another without issues. So I don't recommend that people put cars in a trust.
Awesome. Yeah, thank you guys. Oh, Miriam, you have another question? Don't know if Miriam's there. Okay. Well,
Miriam's got her hand up.
yeah. But she's
Miriam,
not.
You have to go off mute.
Let me one other observation while Miriam's finding that button, which I have trouble finding too. I think that this, like, throw everything in a trust and divide it 3 ways between the 3 kids is, in my opinion, often error when you start talking about planning. Because if you're looking holistic at family wealth, if you have one child, you take Jim's, you have a child that's just, for whatever reason, very successful, and you have another child that's income is low for whatever circumstances, right? They're off preaching, working in the mission field in China, right? So their income is low, right? If that person's income is low, I want that low income individual to get the pre-tax IRA, by example, and I want the high income earner to get the Roth IRA or other assets, right, to minimize the family tax effect. And I think and that could go generationally down too, but I think just kind of look at that holistically, and not the easy divide by 3 and distribute all the assets, because that's always not the most tax efficient manner. I don't know if you've come across stuff like that, Jim or Ellen, that you want to speak to.
I have, but it's what I find most of the time is just getting the people to sit down long enough to talk about what they have and go, because when they're talking about wills and trusts and what's going to happen after death, most people don't want to talk about it very much. Once you get it started and they see some things and then have questions, they might get into it more and more. Now I have clients that have, and I don't have that many anymore. It's less than 100, but as they got old, they had set stuff up, and as they got older, they found other ways they want to do things, and now they look at them very carefully and look at which way it can go and how to do it, and realize that they can change beneficiaries and change things, but they're not always put in a trust like that. I just find it hard to find enough people that really want to talk about what they want to do at death until somebody close dies. And then there for a month or 2, they're ready to do something. But they still don't look at all the assets, or they think that, well, he told me if I did this, everything was in a trust. And, if you want to do a trust and do a trust right, you title the property there. And that's the way it is. Now, we're in different states. In North Carolina, unless property is stated in the will or has already been transferred to a trust, it is transferred on death to the beneficiaries, to the surviving beneficiaries. If it's in a will, then it goes the way the will says. If not, then it goes per stirpes. It's the way the North Carolina does. But it's transferred automatically unless it's specifically stated that it goes to be sold by the trust or the estate. So unless it's titled to the trust, then if it's titled, it's there. But if it's not titled, then it's a different story.
Thank you. Miriam, your question?
So you've talked about not putting a car in a trust, and I think you've talked about the residents not putting it in a trust. But if the whole point, not the whole point, but if one of the points of having a trust is to avoid probate, how would you avoid probate then if you're not putting everything in the trust?
Go ahead.
In North Carolina, I'm gonna say just a minute, and Ellen, in North Carolina, the residence goes automatically either to the surviving spouse or however it's set up, or to the heirs. It's automatic. It doesn't even go through probate.
Well,
It's-
I'm in Florida, and if it would go through probate. If anything that is not in the trust goes through probate. I've dealt with that with the heirs of the client, and they come and oh no, we do have probate going on. That little property they had in some investment thing, they never put it in the name of the trust. Now we have probate.
Well, all states are different. That's what we're saying, and you have to know the rules in the state that you're living in, and I can speak to North Carolina. I can't speak to Florida. But Ellen, can you?
Yeah, in my state, it's the same. It's like Florida. The house would have to go through probate. So in my state, we put the house in the revocable trust. The cars, we don't, but here, we don't have to have probate if the probate assets are less than 50,000. And so we can transfer title of the cars just by going to the MVD and transferring title easily. It doesn't require a probate proceeding, even if it's not in a trust.
In Ohio, on properties on your primary home, you can have transfer on death provisions. So ultimately, the house avoids the probate process. Yeah. If you don't have that and it's just the deed, then it's going through the probate process. And for example, even pour over wills in Ohio, depending on the dollar figure, they will go through a probate process. You can't if there's a will that says transfer everything to a trust, that is a probate process, and there are the fees associated with it.
That's the same here in New Mexico.
Yeah.
If you don't put it titled to the trust, it's going to go through probate to get into the trust unless it's less than 50,000.
Oh yeah, and what's amazing is if you go down to the probate court to basically like ask questions about the estate, they can't answer it at all. Even if you're like, okay, I don't want to use an attorney, but just what forms do I need? I have this asset, and this asset. They will not answer. I had a client where the guy didn't have much. I'm like, go down there, ask them. I have a feeling you're not even gonna have to do anything. Like it's gonna be really quick with probate. She walked out of there with 100 forms. And the person seemed like they kind of made some sense that you need all these things. And she filled it out. She took the time. She got some signatures on there. All she needed to do, she took it back there. And they're all like, "Oh, well, you didn't need all that." She's like, "You're the one who gave it to me." And they're like, "Well," and they'll always say like, we can't give legal advice. And it's like, I get not legal advice, but wasting someone's time like that was ridiculous. Bigger estates, I would see it, but that's where I love trusts, because you don't have to go down to a downtown courthouse to get anything done, and it's all private. So, but
thank you, Bill.
You have your hand up.
I had my hand up. I was waiting to. Our wills say that everything we own go into the trust. What we were talking about a while ago was not having title. Then would that put it into the trust if the wills state that everything we own goes into the living?
Not necessarily. Not necessarily.
Only things that go through probate will then do it.
Yeah.
If you have.
In real estate, North Carolina doesn't go through probate. So as we can see, they're all different. All states are different. And like Bill's situation, we lost a grandson a few months ago. And when his father went to the clerk of court to get the papers to do the trust, they said, "I can't help you." And in North Carolina, we used to be able to go to the clerk of court fill out the papers, represent people. But the attorneys about 15 years ago, 12, I can't remember, anyway, they came and they had a law passed that only attorneys can go to the clerk of court other than the individual involved in the estate. So we cannot do estates, probate estates. However, we can fill out all the forms and give it to the beneficiary, the executor, or whatever, to go down there. And I filled out many forms, and they take it down there and they go right on through, and the clerk likes that. But the point, I just slid off my elbow there, but the point I'm getting at is, if we do it in North Carolina, the attorneys are going to sue us. If that clerk of court does it, they're going to sue them. Attorney, you talk about people that want to sue people, the attorneys are the world's worst. So, I mean, that's just the way it is. So I don't like them having to get all that paperwork, but at the same time, I understand where they're coming from. So
Amazing. Thank
we
you.
can help them. If you knew what they had to have, we can fill it out, tell them what they need, and let them take it to the court. So, excuse me.
Mm-hmm. Yeah, I just wanted to, out of respect for everyone's time, it's almost 3. If you guys don't mind going a few more minutes, I'm also fine with that, just to get through the last few questions we have in the comments. Okay. Yep. You're okay with that, Kelly? Okay. So, Kelly, well, do you have a question, and then we can
unmute Kelly. Where'd Kelly go?
Well, the magic tree disappeared.
I guess he said goodbye.
There are comments in the chat.
Yeah, I was gonna get to those, and then
Okay.
Good. So Maria said, "I've heard that some trust and estate income is taxable to the state of the executor, even if the descendant has no connection with that state. Any comment on this? For example, my parents/in-laws are in Minnesota and Washington, and I'm in Arizona and listed as a trustee/executee."
It's going to wind up where the property is. If they have it in the trust properly, they'll be okay, I guess. But what do you think of that, Ellen? Did you hear him?
I did not understand the question, no.
So
Kemi, if I can, I'll just say it. So Arizona has state income tax, and I read or heard somewhere that if I am an Arizona resident and I am the trustee or executrix of someone's trust or estate, and I'm managing that because I, as the trustee or executrix, am in Arizona, that makes some of their assets taxable or income taxable in Arizona, even though they have no connection with Arizona.
That can be, and each state is different. Some states say that the residency of the trust is where the trustee lives. Some states say the residency of the trust is where the decedent lived. And that varies. And you have to look it up if you don't know, because it definitely varies. I have a situation right now where it is a trust. The grantor of the trust created the trust in New Mexico and died in New Mexico, but the trustee is in Massachusetts. And New Mexico says that it is a New Mexico trust if the trustee lives in New Mexico. So even though the decedent lived in New Mexico, the strange thing is Minnesota, Massachusetts, where she lives, says that the trust is a resident of where the grantor was. So technically, I wouldn't have to file a state tax return because of their definition of what residency is. That is one really difficult part of trust.
Yep. Or estates. Estates are the same thing.
So Ellen, does that mean looking it up, going to the state statutes for the states that are involved?
Yes.
Thank you.
In North Carolina, if you have an estate if the property and the decedent lived in North Carolina and the trustee or executor, excuse me, lives in Massachusetts, they have to get someone in North Carolina to represent that estate. The executor still in Massachusetts, but it's got to flow through the person in North Carolina. So they want to know that who they can serve papers on. The whole thing is so they can serve papers on a resident of North Carolina. And most states are similar reasons.
Bill, you have a small comment?
Yeah. I have a client that's lives in Maryland, and she's terminally ill. So, and she has about a $5 million estate. So ultimately, Maryland does charge estate taxes, but they also charge transfer taxes. And one of the things that I guess I was surprised about, the inheritance tax. And one of the things I was surprised about is the trusts actually don't protect you from that. That, basically anytime you transfer assets to another beneficiary, including a trust, as part of the estate planning, you have to still pay the Maryland inheritance tax, which in her case, because it's extended family members, it's 10% of the assets they receive. And have you all heard that before? Like, because I was like, well, an attorney, let's go ahead, talking to an attorney, I was like, put it into an irrevocable trust. He goes, it doesn't help in Maryland. He goes, and then with the taxes that they pay for an inheritance tax, they get a credit for on the estate tax, but she's going to have something like a $550,000 tax bill from Maryland and for inheritance tax and the estate and the state tax. And I was like, well, let's set aside funds for that. You can't, because it's automatically part of the inheritance tax. No trust protects you from that. I was just wondering if anyone's come across that before and like, Bill, you're told wrong, because I'm like hoping I was told wrong, but I'm not seeing anywhere around it. Which to me, I'm just like, it's unfair as far as taxation.
Well, trusts do not avoid estate tax federally. We don't have transfer tax in New Mexico, so I can't address that. But putting money in a trust doesn't avoid estate tax on the 706 unless it was a non-grantor or irrevocable trust. But if you put it in a non-grantor irrevocable trust, then you have to file a gift tax return.
Correct.
And pay the gift tax. So it ends up combined with the estate later on.
And that's exactly right, because that's what triggers the inheritance tax. I was like, well, if you put it into an irrevocable trust now, then it wouldn't be subject to inheritance tax. It's like, he goes, nope, putting in there now triggers the inheritance tax.
Yeah.
Because ultimately that trust has to go to someone. Whoever it goes to, technically they're the ones who pay the inheritance tax. But she's like, she wants to pay it. But I was just amazed at like how mean of a tax Maryland has. And $5 million in Maryland is nothing.
That's where all those lawyers live. It's the biggest thing out of this is every state is different. Your federal laws are pretty much the same, but you need to understand the laws of the state that you're living in and see what you have to do. Trusts are very complicated. Have you ever tried to get an attorney to explain a trust to you? Again, bypass the attorney and talk to their legal aid. They know pretty much what's going on, and they're usually pretty reasonable people. But trusts are complicated. A lot of people don't want to do them. A lot of people don't know how to do them, and a lot of people do them that have no clue what they're doing. So it's something that it's good to understand. It's good to know. It's good to read. It's good to look up. It's good to ask questions. The biggest thing on a trust before I go anywhere else is read the trust. If you haven't read the trust, you don't have a clue what's going on. And then you have to decide whether you can do whatever or not. But it's very important. And they can be very, very tricky. So,
Okay.
Joshua,
Yep.
are we done?
We just have one last question in the comment, and it seemed like Maria might have had a comment, but if you're all right, I'll ask it. Okay.
Yeah.
So Nancy asked, how would the businesses or LLC need to be titled if they're in an AB trust? The will states a beneficiary to receive the LLCs, but family executor will not sign off.
Would you say that again, please?
Yeah. How would the businesses or LLCs need to be titled if they're in an AB trust? A will states, I guess the will in question states a beneficiary to receive the LLCs, but the family will not, or the executor will not sign off, I believe is what that says.
If it's in a trust, the probate court is not involved. So you're confusing two items.
All right. Yeah. And Maria, you had one last comment, and then we'll.
Yeah, I had another question. When you're counting up the assets to determine if an estate filing is required, and it's the person is married, is it 100% of the assets, or is it that you count up all the assets and then you say that person owns half of them, and that determines whether a filing is required?
It depends on whether you're in a community property or a separate property state and how it's titled. If you are in a community property state and it's community property, then the decedent owns half of it. If it's property held joint tenants with right of survivorship, the decedent owns half. If it's in a non-community property state and it's in the name of the decedent alone, the decedent owns 100% of it.
What if it's in a community property state and it's a business that's only titled to the husband?
What state?
Washington.
Okay, I'm not sure what Washington community property rules are.
Okay.
But probably it's community property. If it's just in his name, it's probably community property, and therefore one half his and one half hers on the 706.
Thank you very much.
Mm-hmm.
Well, thank you everyone for participating. Thank you especially Jim, and thank you Ellen as well. And everyone else who asked questions. I really appreciate you taking the time to hang out with us, and I hope you guys have a good day and take care. Bye, y'all.
Well, Ellen, appreciate it.
Well, thank you, Jim. Sorry,
you, Jim
I
and
kind of
Ellen.
butted in sometimes.
No, you did a great job. I was just trying to do an overview.
Thank you, everyone.
Have a great day.
Bye, y'all.